According to the World Bank report, China's economic slowdown is projected to intensify, with the growth rate slowing from 4.8% in 2024 to 4.3% in 2025, despite the country's recent stimulus measures. The World Bank's analysis revealed that between 1995 and 2019, China's rising import demand contributed approximately 1% to the annual growth in developing countries. This figure fell to 0.67% from 2020 to 2023 as China's growth slowed. So China's growth declined to the projected 4.3% in 2025. The associated benefits for developing nations could diminish, potentially reducing their growth by 0.14% to 0.21%. The slowdown in China's economy will also affect neighboring countries. For example, growth in East Asia and the Pacific, including Indonesia, Australia, and South Korea, is forecasted to fall to 4.4% in 2025 from around 4.8% this year. China's rapid expansion has positively impacted its neighbors for decades, but this influence is now waning. Recent fiscal measures such as interest rate cuts may offer a short-term boost to China's economy. However, the World Bank stressed that long-term growth will depend on deeper structural reforms. China's government set a growth target of around 5% for 2023, but that goal has become harder to achieve due to weak consumer demand and ongoing challenges in the property market. Before I proceed, I encourage you to consider liking the video and don't forget to share your views on the topic in the comment section below. Your feedback is invaluable for us and a wider audience around the world. A negative wealth effect from falling property and stock prices, as well as low wage growth amid various industries' cost cutting, is dragging consumption and causing a pivot from big ticket purchases towards the basic eat, drink, and play themed consumption. The years-long property crisis deepened in June as new home prices fell at the fastest pace in 9 years, battering consumer confidence and constraining debt-laden local governments' ability to generate fresh funds through land sales. Along with rising policy uncertainty, shifting global trade and investment patterns could further strain the East Asia and Pacific region. US-China trade tensions have created new opportunities for countries like Vietnam and India, but stringent rules on imports and exports limit their potential. To counteract weak domestic demand, we believe more policy easing is necessary through the remainder of this year, especially on fiscal and housing fronts, said Goldman Sachs economists led by Lisheng Wang. Economic growth in China has been uneven, with industrial output outstripping domestic consumption, fanning deflationary risks amid the property downturn and mounting local government debt. While solid Chinese exports have provided some support, rising trade tensions now pose a threat. The World Bank also highlighted how emerging technologies, including artificial intelligence and industrial robots, are reshaping the labor markets around the world. While AI threatens fewer jobs in the Asia-Pacific region compared to advanced economies, it also means these nations may struggle to fully harness the productivity benefits offered by such technologies. Moreover, if China's exports continue to exceed imports, showing a 4% increase in merchandise exports compared to a 2.8% rise in imports over the first 7 months of this year, then, as the World Bank's report suggested, that the negative impact of heightened competition in international markets may overshadow the benefits of increased demand. Investment levels also play a critical role in China's economic slowdown, with real estate investment plummeting 26.7% from its peak in June 2021 due to persistent challenges in property market. Simultaneously, China's manufacturing sector is grappling with demand-supply imbalances as overall industrial capacity utilization declined to 74.9% in the first half of 2024, down from 76.7% during the 2017 to 2019 period. This continuing slowdown is expected to present significant challenges, especially for East Asia Pacific countries that have historically benefited from China's expansion, the report added. While 2024 witnessed a rebound in services consumption and exports in world's second largest economy, ongoing weakness in the property market and low consumer confidence are expected to hinder future growth. Although recent fiscal support may offer short-term relief, the report emphasized that sustainable growth will require deeper structural reforms. This analysis arrives amid concerns over the lack of adequate economic stimulus from China. Recently, in a press briefing, officials from the National Development and Reform Commission refrained from announcing new stimulus measures, disappointing investors despite expressing confidence in achieving this year's economic targets and promising further support. Household consumption remains very weak, with employers slashing salaries and high youth unemployment. Households will still be cautious going forward, said Xing Jiaoping, senior China strategist at ANZ. Property investment fell 10.1% in the first half of 2024 from a year earlier, and home sales by floor area declined 19%. Here the question arises, is the Chinese government doing something to control slowing economic growth? Yes, mounting pressure has forced the Chinese government to step in. Over the past month, China has put forward significant economic stimulus measures to revive its faltering economy. According to a research note by Deutsche Bank, this stimulus could potentially become the largest in history in nominal terms. On September 24, Pan Gongsheng, governor of the China's central bank, unveiled the country's boldest intervention to boost its economy since the pandemic. The initiatives included reducing mortgage rates for existing homes and reducing the amount of cash commercial banks are required to hold in reserves. The latter is expected to inject about 140 billion US dollars into the financial market by letting the banks lend out more. China has been grappling with an oversupply of housing and a property sector crisis. 112 billion US dollars was announced to strengthen China's capital market. This comprised a new 70 billion US dollars monetary policy facility to help institutions more easily access funds to buy stocks and a 42 billion US dollars relending facility to help speed up sales of unsold housing. 2 days after this announcement, further signs of economic revitalization become evident at a Politburo meeting of China's top government officials. Chinese President Xi Jinping stressed the urgency of economic revival. Xi even encouraged officials to go bold in helping the economy without fearing the consequences. That same day, 7 government departments released a joint policy package to stabilize China's 70 billion US dollars dairy industry, which has been severely impacted by declining milk and beef prices since 2023. Thank you for watching, and don't forget to subscribe to our channel for new videos on important international topics.